Hello and welcome to this video. In this video I would like to go into DCF valuation and explicitly into the adjusted present value method. For this video I planned the following. First of all, I would like to give an overview over valuation techniques. And then I would get deeper into present value based methods and the so-called rollback method. I would like to introduce Modigliani-Miller theory as of 1963 into valuation, and I would like to make some assumptions for our valuation that we're going to perform. Then we go deeper into adjusted present value method, first into the perpetuity and then rolling backwards the detailed planning period. And of course we're going to implement all that in Microsoft Excel. Now, this is an overview over valuation methods. We can roughly divide it into the asset value methods, the multiples, the present value based methods, and the real option methods. The asset value methods assume that the company, the value of the company, is made of its parts. So it's just like financial reporting. We see financial reporting here because it's asset value methods at book value. Each individual item of the company will be valued here at the book value, or alternatively at its liquidation value, or alternatively at its reproduction value. Since we all know about accounting, we know each individual item, each individual asset has to be valued at book value. That's quite a lot to do, and it does not fully reflect the value of the company, because the sum of all parts does not equal each individual part valued individually. Nevertheless, the so-called liquidation value, so all assets valued at their liquidation value as if you want to sell them, is usually be meant to be the lower bound of every business valuation. Why that? Because it's always an alternative to liquidate the company. And the reproduction value also is important, because if you decide whether to buy or whether to build a company, the reproduction value is an important figure to keep in mind, because it's always, if it is cheaper to build a company, the reproduction value will be your investment. Otherwise, if it is cheaper to buy, of course, you need a present value based method. I've already gone into multiples in another video, so if you're interested in multiples, don't hesitate to watch that video. Typically, multiples are used as market multiples. So you will need a different company, another company. You derive the multiple and you apply that multiple to the company that you want to value. So you compare those two companies underneath each other. You can divide those market multiples into equity multiples and into entity multiples. Equity multiples, of course, value the equity of the company, the shares. Entity multiples value the whole entity before financing, so they revalue the capital employed. The recent acquisition method or recent acquisition multiples, they are used if there is no market price available. So you need some recent acquisitions that have been performed. You know the price of those acquisitions, and then you can apply the recent acquisition multiples. Present value based methods are based on present values, of course. So they have to discount a stream of cash whatsoever. The mother of all those present value based methods is the so-called dividend discount model, which means that the projected or forecasted dividends of a company are getting discounted. Nevertheless, this inherits several problems or several disadvantages. First of all, the dividend is not easily forecastable because it depends on the dividend policy of the company. And you cannot forecast the dividend policy. If you cannot forecast the dividend policy, it would be a good idea to capitalize or to discount the earnings, the profits, or alternatively, the cash flows, discounted cash flow methods. So here are two solutions to the problem that the dividend is not easily forecastable. You can answer this question by discounting the earnings, the profits, or you can answer this question by discounting the cash flows. Why is there a problem? Well, the earnings are kind of opinion because the management can adjust the profit up and down. It's up to them, while cash is always the truth. That's why, especially in Great Britain and the US, discounted cash flow models were derived, while in continental Europe, the capitalized earning method was for a long period of time the method that was in use. Nevertheless, both methods can bring the same values. That's not a big problem if they are derived correctly. The DCF models are a bit more modern since they inherit Modigliani-Miller theory, Modigliani-Miller theory as of 1963, so financing theory including tax. We can further differentiate all those methods into equity methods again, just like the multiples. So the equity multiples are equity methods, of course. The capitalized earning method is an equity method, and the flow to equity model from the DCF models is also an equity method. And of course we see entity methods like the entity multiples, the adjusted present value, the free cash flow or WACC method, and the total cash flow. Last but not least, there are real option methods. Real option methods are based on option pricing. They are not so common in practice. They are only used, for example, for pricing oil, digging rights or something like that, or mining rights. Okay, so the present value methods are based on present values, of course. Nevertheless, we have the so-called going concern principle. So we assume that the company is living forever, that it will not be liquidated after a few periods of time. So we need some technique that I have already shown in a different video. We need a different technique to discount those everlasting stream of cash flows. This technique is called perpetuity or the Gordon-Grove model. Nevertheless, since the Gordon-Grove model only discounts one single value, it might be a bit rough to use it. So, how can we do it? We typically split our planning into a detailed planning period, maybe made of 5 periods, 1, 2, 3, 4, 5, and we assume that the 5th period stays forever or grows at the single growth rate forever. So then we can use the perpetuity or the Gordon-Grove model to find the value of the perpetuity in period 5. So we see this arrow here, and we then have a present value of the perpetuity or of the growing perpetuity in period 5. But then, of course, we have to go down, and this will be typically done as a recursive procedure or rollback procedure, which means period by period. So we go backward, we have the present value here, and we have the cash flow as of period 5. We discount both and find the present value as of period 4. Again, adding it with the cash flow and discounting both, we have the present value as of period 3, and so on and so forth until we reach the present value as of period 0. That is typically meant to be the present. As I said, discounted cash flows are based on Modigliani-Miller theory. Modigliani-Miller theory, I have already done another video. Please refer to that video if you're not so much into Modigliani-Miller theory. Modigliani-Miller made assumptions about the cost of capital in a company. And they have this adjustment, or have derived this adjustment formula. The cost of equity of the levered company, so levered means depending on the leverage ratio, the use of debt, that equals the cost of equity of an unlevered company plus, in brackets, the cost of equity of an unlevered minus the cost of debt, which is assuming the risk-free rate, times the leverage ratio, which is non-current liabilities, divided by the equity. I have replaced the equity here by V, which is the market value of the equity, because if it comes to business valuations, we always replace equity by market value of equity, because it has to be based on the market value typically. And 1 minus t. And 1 minus t is the tax. Since the interest is deductible from the tax base, it becomes more and more advantageous to use debt. So with the leverage, the cost of capital, the WACC, decreases while the cost of equity increases due to the leverage. So, based on this assumption, and we will later see why, or in another video we will see why we need this formula, the DCF methods are based on these assumptions. And again, we have to split into entity methods and into the equity method, and we can derive 4 different methods, all of them are showing the tax shield differently. The APV, which stands for adjusted present value because they adjust the present value in another term. So they have the tax shield considered in the cash flow but in a separate term. And they use the free cash flow as the cash flow definition, but the free cash flow not like we might know it from the accounting, just operative plus investment cash flow. No, it's the free cash flow of an unlevered firm here. And the discount rate is the cost of equity of the unlevered firm, which means this point. And of course the cost of debt for the valuation of the debt and for the valuation of the tax shields. The WACC, or free cash flow method, also uses the free cash flow of the assumingly unlevered firm, but the tax shield is included into the discount rate. It is not in the cash flow, it is not in a separate term, it is reflected in the discount rate. So in other words, APV and WACC, or free cash flow method, they're both based on the same cash flow definitions, but they have different discount rates. So the difference between the discount rates, of course, must reflect this individual term from the APV method. The discount rate here is the WACC that we already see here. The total cash flow method, which is quite an elegant method, but it is not applied a lot in practice, is based on total cash flows. Total cash flows are more or less close to free cash flows, but they are adjusted for the tax shield. So the tax shield is here considered in the cash flow. And the discount rate differs a little. It's also a WACC, but without 1 minus t. So no tax shield reflected in the WACC. It's just WACC, but no tax shield in. The equity method is based on the flow to equity, which is the cash flow that is generated and distributable to the shareholders. So the flow to equity, of course, the tax shield is considered in there because it's an equity method. And the discount rate is the cost of equity of the levered companies. So depending on the leverage, we have to pick that discount rate that is applicable here. Let us make a few assumptions for our valuation that we are going to perform. Usually, the cost of equity or the cost of capital will be derived using the capital asset pricing model and explicitly the security market line that is shown here on the right-hand side of the slide. We see that the expected return of the company, that can also be called mu, is given by the risk-free rate plus the market rate minus the risk-free rate. And what we see in brackets here is the so-called market risk premium that has to be multiplied by the individual beta factor. And, well, we assume that the asset beta is known. The asset beta is the beta of the unlevered company. The asset beta can be derived from peer group companies, but they have to be re-levered using Modigliani-Miller formula before. So the asset beta here is 0.8. The cost of debt equals the risk-free rate, which is 8% here. Why does it have to equal the risk-free rate? Otherwise, we would leave the Modigliani-Miller world and end up in some trade-off theory world like Krauss-Litzenberger, but this is usually not implemented in our DCF models. And the long average market return for RM is 10.5%. Now, of course, we can input those numbers into the security market line to get our cost of equity of the unlevered company. Unlevered because we apply the asset beta here. Okay, so the cost of equity of the unlevered company is 8%. This is the cost of debt plus 10.5 minus 8% times 0.8, which is the beta factor, and we have 10% cost of equity of the unlevered company. The planned financing structure is autonomous. There is a huge discussion about the planned financing structure. Autonomous means that we apply debt as a plug in our planning. There are different ideas how to adjust future financing structures, but I think autonomous is the usual or practice-oriented assumption that can be made here. Coming from this assumption, the adjusted present value method is the preferable method of all 4 DCF methods. Only corporate taxes are considered, not personal taxes of the shareholders. There is a whole number of models that introduce personal taxes into the valuation, and that also makes sense, definitely, but in this case only corporate taxes are considered. And the corporate tax system is simple, with taxable profits being taxed at the corporate tax rate tau. Why is it tau here? Because t is the time in this slide deck. Now, let us come to the adjusted present value method. As I already said, the adjusted present value method shows the present value of the tax shields individually. So, the value of the company, which is the equity value, the market value of the equity, is composed of the entity value of the unlevered firm, the present value of the tax shields, minus the market value of the non-current liabilities, so the debt. Usually the debt is assumed to equal book value debt, so we don't need to perform any calculations. Here we just take book value debt. Nevertheless, we see that we have the entity value of the unlevered firm and the present value of the tax shields, so the advantage coming from the leverage. Accordingly, both together would give the entity value of the levered firm. I already showed this slide. First, we now start with the perpetuity. So the valuation formula for the perpetuity is the free cash flow for all future cash flows starting in t+1, discounted at the cost of equity of the unlevered firm. Let us just have a look. Here we calculate the entity value of the unlevered firm. Accordingly, we need to have the cost of equity of the unlevered firm, and we arrive at the entity value of the unlevered firm in T, so the last period of our detailed planning period. And we have to perform the same for the tax shields. So the planned tax shields as of time t+1, so 1 year after our detailed planning period, they have to be discounted at cost of debt for the same for the period t to arrive in the present value as of period t for the tax shields. Now, having performed this discounting, having ended up in this present value, we now have to roll back period by period. So the entity value as of period small t is the entity value as of t+1 plus the free cash flow as of t+1 divided by 1 plus, because we only discount by 1 period, 1 plus the cost of equity of the unlevered firm as of period t. And the same is true for the present value of the tax shield. So the present value of the tax shield as of t+1 plus the tax shield as of t+1 will be discounted by the cost of debt as of t, and of course we have to add the 1 because we only discount for 1 period. Now, let us go into Microsoft Excel and let's see how that works out in practice. Okay, having arrived in Microsoft Excel, you see I've put everything on one sheet. So we see the cost of equity, which is given here, assumingly 10% derived by the capital asset pricing model. The cost of debt, which is 8%, and the tax rate, which is the typical German combined tax rate, Körperschaftsteuer, and so on and so forth, Gewerbesteuer, 26.325%. We see a simplified balance sheet here with the non-current assets and the current assets, and of course both together will give the total assets. We don't see, and please mind that, we don't see the cash balance here. the cash balance is included in the non-current assets. Why do I point out on that? Because later, if we see the cash flow calculation, the change of the non-current assets also inherits the change of the cash. That means that the change of cash is implicitly an investment into or a disinvestment out of the cash balance. Equity and liabilities, again, of course, here are the non-current liabilities, which is our debt. So interest will always be calculated on the non-current liabilities. And we see the sum, and we have checks that both balance. Fine. So let us come to the income statement. We have a revenue line, cost of goods sold line, we have an EBITDA, we have the depreciation, we have the EBIT, we have the interest. The interest is calculated as 8% on non-current liabilities, but this is the second point we have to mind. 8% are levered on the debt of last year. So it is not in the same period, it is the debt of last year, the non-current liabilities as of last year, time 8% will give the interest. We have the usual calculation, Gewerbesteuer and Körperschaftssteuer here. I made this explicitly, but you can also do it implicitly using 26.3.5% if you like. Then we have the profit, we have retained earnings and dividend. Both is not so interesting here. It can be interesting if you want to find out about the financing needs of next year. I excluded that from this planning here. Okay, now we need to calculate first the tax shield. The tax shield is the tax rate times the interest. So 26.3.5% times the interest taken from the profit and loss. And doing that for all periods, we have the tax shield here. And we can all directly discount the tax shield. Attention, here of course we have a different formula because this is the perpetuity formula. Simply dividing the tax shield here by 0.08, or I can also write cost of debt because I have taken those variable names that will end up in the same number. Here, by the way, of course we go roll back. I can also use cost of debt here and we will have the same results. So this is rollback formula number 1. Then we go into the cash flow calculation. And of course the cash flow calculation should be very much the same as we note from accounting. So first we calculate the cash flow from operations. It's like profit plus depreciation minus plus the change of current assets. Then we have the non-current assets and the depreciation, which gives the cash flow from investment, and both together will give the free cash flow as we know it from accounting. But this is the free cash flow of the levered company, but we want to have the free cash flow of an assumingly unlevered company, so we have to make some adjustments for the valuation. First of all, an unlevered company would not pay any interest. Accordingly, we have to add the interest again. But we have to subtract the tax shield because this company would now pay more taxes since they cannot deduct the interest. So the tax shield has to be added. And then thus we end up in the free cash flow for the APV and for the WACC method. And now we can discount this free cash flow again here using the perpetuity formula. I can also use COEU, which is the variable name that I gave this field, COEU. And here, of course, we have the rollback formula, COEU. Rolling back, and we end up in a present value of 1955 for today. Of course, it would be a bit better to show that it is a different formula, so using a different color for the perpetuity spots on that it is a different formula applied here. Now the adjusted present value method, the valuation is pretty easy. We have the present value as of here, it's the same we have here. The present value of the tax shield is given here. That's the same that we already saw here. Adding both will end up in the entity value of the levered firm, and minus the debt minus non-current liabilities will end up in the equity value of the firm. So I hope you liked this video. Thank you for listening. See you in the next video.